All right, and we're live. So, good morning, ladies.
Good morning.
Thanks. Hello, everyone. Happy Saturday, or whenever you're viewing this. So this is going to be our monthly mortgage market update with myself, Gabriela, Cernas-Frantz, and we also have Brittney in the building as well, coming to help us out when it comes to understanding some of the news and things that are happening in the market. So let's begin. All right, so once again, the goal of this YouTube page and also for my channel is I'm a huge fan of people being able to be debt-free. And one of the biggest ways to get to that point is through home ownership. So purchase a home and you're able to refinance to be able to pull out money to be able to pay off your debts. That allows you with only having to pay off your home to get to a point to where you are living a life of being debt-free. Kind of like the reverse Dave Ramsey. But continue, please. Before we're starting, what is something that has been on your mind lately in the mortgage industry? Just kind of like pressing at you. Let's start with Brittney since she's our guest.
Well, I've been talking with agents lately at some events, and they've been saying that they've been at least feeling a little bit of a change this month.
Okay.
So that's been on my mind lately, that they're feeling a little slight change in the market. There's I won't say no longer 30, 40 offers on properties, but they're seeing it a little bit less.
A little bit less.
So the crazy, might as well not even make an offer because there's too many on it already, is starting to shift a little bit and slow down.
Yeah.
So that's been some news in my world.
Good. I'll piggyback off of that. Seeing a slight slowdown as well. The one thing I've been thinking about, which kind of tags into what you're saying, is that they're seeing these slowdowns happening. And of course, you listen to NBS Highway and some of those big people, they're stating that they see that the market should slow down even more because the interest rates rising, things of that nature. But it's definitely going to be a pocket situation. So we're in the Tampa Bay area.
Right.
We may have a slight slowdown, but even if a recession happens later this year, we may not ever really fully see a slowdown fully happen. While, for example, Sean, who's on the team, he's buying properties in Georgia. He's seeing the slowdown happen a lot more than what we're seeing down here, drastically. So whether you're in Georgia, Tampa, Miami, California, Colorado, it could end up being, it will end up being more of a pocket situation when it comes to how these markets affect you over the next year or so.
Right, how much we feel it. Yep.
You got it.
Yeah.
Gabriela, anything?
Oh, I'm not going to add anything much to what you guys are already saying because it's what we're hearing. Brittney and I were at an event, and that was something that was brought up. Some houses are a little bit longer on the market now, so maybe there's some reflection on, are we pricing the homes where the market needs to be? So realtors are having a lot of conversations with their sellers right now about pricing the homes correctly, because anytime a home in the previous market was on for more days on the average market, more than a week, 2 weeks, 20 days, there was like, what's wrong with the house?
Right.
Should we be concerned? And those are those slight changes that they're starting to notice a little bit more. So is it a trend? Until we see more coming through, then we won't know until that happens. But those are conversations that are happening locally.
Yeah.
Agreed. We'll definitely need a lot more data, unfortunately, from what we're seeing right now as of last month. Especially in our area, like homes that are, whether they're in the $300,000 range, $500,000 range, 1 million plus range, these homes are being sold in less than a month.
Yeah.
No matter where it's at. And that's not the way it's supposed to be. It's supposed to be, if you're around 300, 400, 500, a range that a majority of first and second time buyers in the majority of the market are at, those can be less than 30 days, which, it's still not a healthy market fully, but that's more understandable than homes that are 1 million plus being sold in less than 30 days.
Yeah.
Technically, those should be a little bit longer. But let's see what we got. All right, so rates, how they work. I'll quickly, knock this out, and then we'll go into the actual rates. I know when you're talking to mortgage people always want to hear about rates. We don't like to talk about them as much because it's not as important as other things like monthly payments, etc. But the rates, the way they work is, Federal Reserve, they lend money to banks. They set the rate that it can be able to lend for them. The higher the rate is, the higher all interest rates are. Car, mortgage, personal, etc. It doesn't have a direct correlation with mortgage rates, but it has a slight correlation with it though. But in mortgages, there's another term, another item that greatly affects rates, which is called mortgage-backed securities, which, sparing all the details, this goes up in value, rates go lower. If it goes down in value, rates go higher. So let's check out this slide real quick. Unfortunately, as you can see, this number has been going down a lot over the past 5-6 months, which in turn means that rates have been going up over the past 5-6 months. Brittney, our guest, what do you feel about what's happening with rates, where it's headed, things of that nature?
We're not able to predict rates. If we could, we would have a different business model, and we certainly would be very well off and not be doing this every day probably anymore. But what the talk of the town has been is that they're not projected to go back down. They may stay in this range of 5s, hopefully, for a little bit here, but slowly increasing throughout the year is what we are hearing. So we'll see where the year ends, but obviously we hope that they stay bobbing around what they have been, but each day is different, and it's been a different market since January. It certainly has been fast, very fast, and so we're hoping for some sort of stability, but we'll see.
Yeah. We normally when we see these charts, we'll see, it'll go down some, then it'll go up and down and go up, and you're normally not seeing, as much red as you see on the graph right here. Gabriela, any comments on this?
When I look at these graphs, I look back to the beginning, none of this actually made sense, and it took some time, working with you guys to actually understand it, when it's down, the interest rates are up, but to relate it back to the real estate market itself is that, while the rates are going up, home, equity values have also increased, and that's significantly different than it was even in 2007, 2008, so because that's the last major event that happened with homes in the mortgage industry. So I agree with Brittney, it is ideal that it stays within that range, but we also have to change the conversation with the buyer about how it may, they're going up from based on last year. We also have to look at the home equity value.
Yes, that's a huge point, because in 2018 we had rates in the 5s. I was locking my buyers in the 5s. However, they did not have the amount of equity that they have today.
Yeah.
So it's a different market, different conversation, and bringing it all back to the original point of 5s is still very low, and it's still pretty cheap money.
Agreed. To hit on one of the points that Brittney mentioned, we're not in the market for projecting what rates are going to be. That's not our job. And even the experts, they're not good at projecting rates either. Every single last expert, end of last year, beginning of this year, all rates, they should go up, but they should only go up no higher than the high 3s.
Yeah.
When we were, towards the low 3s, sometimes in the higher 2s.
Right.
They're all projecting, every single last one of them, no more than high 3s.
Yeah.
And within 6 months, we're already in the 5s.
Mm-hmm.
And I was just listening to Barry Abib, who's one of my favorite people earlier today. Inflation is the biggest driver of mortgage rates, and inflation is projected to still increase over the next few months.
Mm-hmm.
So it's already increased this quickly. We're in the mid 5s, upper 5s right now.
Yeah.
And by the way, you have 15 different rates you can choose from once you're under contract. It's not like you only get one rate, but the average rate in the middle, looking at mid 5s to higher 5s. And then if that inflation continues to increase over the next few months, mortgage rates could potentially go even higher. We can't tell you how high it can go, but when it comes down to it, 6%, 7%, who knows? Most important thing for you, if you're a buyer listening to this, is going to be your monthly payments. If your monthly payment works out for you at a home, then that's going to be, you can be able to afford and get that property. If it's not going to work out for you, then you need to adjust that to get towards a purchase price.
Right.
That'll work for you and your family.
I mean, certainly the answer is not to just wait. That's for sure.
You definitely do not want to wait.
I mean, if anyone is thinking, well, I'll just wait it out and I'll see if they go back down, prices are, going to continue to at least slowly rise. It may slow down to a slow rise, but they're not going to get cheaper, and the rates aren't going to get lower.
99.9% of my buyers right now are stating that, when home prices go down again, when the market crashes again.
Right.
And I think that's how it works, People who aren't in the business, even tons of real estate agents are preaching and coaching this. And I mean, you go on the news, they tell you these things. They all think that it works like a recession. A recession happens, everything in the market goes down, including homes, and then you keep going up. But the reality is 7 of the last 8 recessions, home prices have continued to increase during them, and they only went down in 2008 because of people not having equity in their homes. Interest-only loans and 125% refinances where people can pull out cash at 125% of the value.
Right, yeah.
Things of that nature.
Those things aren't happening anymore, yeah.
So,
and I mean, I always tell consumers that you cannot perfectly time the market. If you need to move, if you need to downsize, upsize, you need more room, you need to move because of a job. I mean, you can't perfectly time the market. People need to buy, and they're always going to need to buy.
They are. Good. Let's see what else we got. TBDs. I want to speak about TBDs. This is to be determined loans. This is something that's at the heart of what we do at the company that we work for, which is, you have the process of speak with the mortgage person first, like before you're going out on Zillow, looking at homes, etc. Get with us first. We can get you pre-approved normally within 24 hours. Once you're pre-approved, now your real estate agent's doing 95% of the job trying to find you the home. But during that period of time, at least at our company, we can be able to submit these loans into underwriting if you give us enough information so you can be what's called conditionally approved before you're actually under contract for a home, making your offer almost similar towards cash, a lot smoother process, things of that nature. How is this going for you and your business? Being able to do this?
Yeah, it's huge. It's multifaceted. There's so many reasons why it's a benefit. You could have a traveling nurse who used to be regular hourly permanent rate at a hospital like Tampa General in Tampa. However, 2 years ago, during the pandemic, they decided, I'm going to travel and I'm going to do travel nursing. There's some great opportunities out there. They're paying great. So they started traveling, doing contracts for 3 months. Someone like that, we're going to need to average the income that they've been getting with these different contracts. So someone like that, it's a great opportunity. Get them in, get them underwritten, get the underwriter in there looking at everything and give a solid answer as to how much income we're counting for them. And then everyone feels better. We know exactly what they can afford. The agent knows exactly what to get out there showing them. And it gives people so much more peace of mind than just the initial paper that says, I can do this price. So for someone like that, it's great. And for anyone that just doesn't really have the time, they're busy working, they have families. While you're out home shopping, you might as well have us doing all of the legwork, paperwork, documentation, all of that stuff. It just makes for so much more of a smoother process when you do go under contract. I always tell my buyers, things roll really quickly after you get that signed,
Very fast.
So everyone's kind of like, okay, here we go. And the ball is rolling. And to have to go back and say, okay, great, congrats, you got that offer accepted. Now, can you gather all that documentation? And, it's almost now for us, since we've been doing these for years now, it's almost a step backwards to do it that way. When you go under contract, you have to get a home inspection scheduled. And then comes the appraisal, all of that good stuff. And there's so much to do that if you already have our side handled, it takes so much pressure off.
Agreed.
Yep. And
Agreed.
Also faster closings. And that is something that a seller really likes to see.
Yes. A lot goes into it. Faster closings, more smoother situation for the buyers when it comes to what they got to get done once they're actually under contract. And then just the whole guidelines part of it. You could be in the business 5 years or even 30 years, but all of these loans have so many guidelines.
Yes.
And many of them, some are black and white, it's either just black or white, this is the issue, but many of them are gray areas.
Yes.
And depending upon the underwriter, they may see a loan slightly differently. So getting it to an underwriter ahead of time.
Mhm.
And then once you're under contract, it's going back to that same underwriter. Makes the
Yes.
process a lot smoother.
Yes, yeah, you already have a relationship with your loan processor. You
Yep.
already have been assigned to an underwriter. So many things done ahead of time for you.
Good. Gabriela.
You guys are the experts on this. The only thing I had, as you guys are using the terminology of, getting it reviewed by an underwriter, let's mention what those documents are. We want to verify their income, as you're saying about the traveling nurse and having to, calculate their income over a period of time, 2 years, 3 years, whatever the requirements are. But there's also, sometimes the curveballs, when we're dealing with, individuals who are divorced and have to provide documentation. If they have bankruptcy, there's more documentation. So, when you have a very unique situation where more documentation is needed, you're going to need that time to have underwriting and processing and then underwriting review all those documents. So there is no surprises that once you sign that contract and get ready to go, all that's been cleared. You get the conditional approval and you can start, and it makes the realtor's job really easy at that point because they're not nervous that okay, something's what's going to come up, something that the borrower didn't let them know, because the realtor-buyer relationship is different than the the client and lender relationship. We're looking at very private, financial, and sometimes personal information that has to get reviewed. Whereas the realtor, their job is like, we got to find a home in your budget, in the area that you want. So we're doing that work so that the realtor can go and take care of the client.
Right.
So we're essentially facilitating two different relationships. I kind of look at it that way, so that, but it also, us conveying that to the buyer, like the sense of urgency.
Yes.
It's changing the mindset of like, don't wait until that contract is getting signed.
Right. I was just going to say, I'm pre-approved buyer. It's a sit and wait time period until you find the house, and then go, and very stressful for some. So why do that? Why sit and wait when we can do it ahead of time?
Yeah.
And let's touch on what it means for the sellers when they not only get a pre-approval letter, but they get an approved letter.
Yeah.
So many of our offers are getting accepted for our buyers over others because it's all been done already. So, they feel much more confident in taking that offer as well.
You got it. Provides a lot of security.
Yeah.
Good stuff. What else you got? Record low inventory. Many experts are saying they're not seeing a housing crisis in sight. I mean, if you've taken any basic economics course, if supply is low, that leads to higher demand, and the reverse. And looking at this, this graph goes back many years. I mean, this graph goes back to 83, and we are at a record low by far when it comes to inventory compared to the peak, which was 3.7 million homes in the nation on the market. Right now, we're at 870,000 homes in the market. Brittney, what do you feel about this?
It can sway things certainly with low inventory, but I think that it's going to start calming down a little bit. I think with rates rising to where they are, some have backed off of buying, and then we're going to create at least a little bit more inventory here.
Yeah. It's a situation to where how many buyers are putting in offers on a property. Right now, many listing agents have been getting 15, 20, 25 offers on a property. With some of the things that's going to cause, the higher interest rates, things of that nature, depending on the market.
15 is going to go to at least 5.
It hopefully can go to at least 5, because when it was 5, that was considered a lot. I remember the reports that came out. I was like, hey, they're getting 5 offers on every property.
Right.
This is a lot. This is what's happening right now. So if it goes back down to 5, it's still a good market. If it goes down to only 1 or 2, then that ends up becoming a market that's more on the buyer side. They can be able to put more lower offers in, and it changes things a lot. But it takes a lot to go from 20 to 5 or 20
it does.
2.
And going down to at least 5 offers on something really opens up more opportunities for families, young families that are making their first offer or their second offer on a home, whereas they were just getting beat by investors or people coming from other states that are higher priced and thinking this is super affordable, I'm gonna make an offer on it and buying those up.
Agreed. We spoke about this in our last update was the number of investors that are coming into the market. Like there's maybe like 5% were in the market 10, 15 years ago.
Right.
And now the number is up to like 20, 25%.
Yeah.
And they're not having any plans of slowing down. Like
Right.
this is their game. Their game is to buy these single family properties, which are useful for families,
Right.
and they're planning to rent them out for a long period of time. This isn't fix and flips where families can sell the property a few months later. This is they're trying to buy these properties and have families rent them for a long period of time. So we're in the business of having families buy home,
Right.
and that's a part of my life goal is to help them buy home, refinance, get out of debt, etc., rather than these investors put them into. So, you know, if that shrinks to where these families can be able to more easily get the properties, it's a good thing.
Yeah.
Gabriela.
I mean, the only comment, you know, as far as like when investors, because we do, you know, mention that quite a bit, is that, you know, you have your novice investors and then you have your capital-backed investors. And, you know, there was a big opportunity for the average person to take out equity in their home and purchase a second home. And something that was probably brand new to them, you know, like the mom and pop entrepreneurs of, you know, getting into the real estate investment game. And, you know, something that people sometimes forget is that that's a whole nother business in itself. You are now responsible for the living welfare of a tenant in a home that you own, the liabilities, insurance. You know, there's a lot of responsibilities. Actually, my sister, you know, had an investment property, and this is way before, you know, the market values and everything started changing. There was more inventory in CP, and they held on to it. They rented it out because they started seeing that there were people coming in to work in the hospital areas in CP. Well, they decided to sell it last year, and we looked at, you know, what the value was at that point. And something interesting that I noticed about them was like they didn't want the responsibility anymore. And so they were that novice investor and they were really excited about buying more properties. But when they looked at all the responsibilities of it, they were realistic and they said, we don't want to be responsible like this anymore. So, you know, there's different types of investors. We're kind of grouping them into one.
Correct.
But we also have to look at like the mom and pop investors, I'm going to call them that, you know, it's probably a cuter term. And they will sell eventually when they can't manage it, or they'll sell it to that tenant because they've been a good tenant for so long. Mm-hmm. But will that make a big impact in the inventory? Not necessarily. We go back to like people still have to buy and sell because life still happens to them. And even in the area, I know Pasco County is looking at building 3,400 homes in the middle of Pasco. It's going to be one of the big builders and stuff. So, you know, builders are still trying to find inventory. They're still trying to buy dirt and build inventory, but that's going to take some time. So we're not going to see those immediate numbers this month. Yeah, that may be, I don't know how long it takes to build a house. I've seen quite a few pop up in my neighborhood, anywhere between 6 months to, 9 months. Yeah. So if that's coming, we're just not seeing it right now.
Sure. I'll agree with you. Novice investors, experienced investors.
Yeah.
So when it comes to the number of investors buying homes, when that number goes from 5% to 20% of the market being investors, you have your mom and pops that are doing it, and it'll be really tough for them if a recession happens, because if you see your 401ks and all your other portfolios go down 30%, if you potentially get laid off from your job, it makes it like you buying more properties becomes a lot less, of something that you want to do during times of that nature. Yeah. But the big time investors, the ones that are pulling cash from, tons and tons of different people in different places, that'll be interesting to see how that goes, if times get kind of, tough with recessions, rates, things of that nature. Yeah. What else we got? All right, affordability versus last year. This once again is something I pulled from one of my favorite guys, Barry Abib. Just trying to make it make sense for buyers. So many buyers will say, "Oh, home prices have gone up, even interest rates have gone up." And if you look on the news, they'll never give you the flip side which is that household income has also gone up as well. So for example, in the charts that we're looking at right now, let's say even if homes appreciated 18%, went from 400K to 472,000 for 2021 to 2022, let's say rates went up. In this example, they had to go up a little bit more. It went up from 3.3 to 4.7. It's a bit higher than that right now. Monthly payments on that same property probably went up around 690. But household income, if it went up 10% from 9,000 a month to 9,900 a month, that's also going up, about $940 a month, to where you're still having a net positive. You're talking about the income you're bringing in versus your potential monthly payments with these higher purchase prices, higher rates. Brittney, what are you getting from this? What are you feeling about it?
Well, it's very interesting, yeah, because to your point, all you hear about is the rates and prices of homes going up, and it's very discouraging. It's discouraging for not only first-time home buyers, but any buyer, someone who's in their house right now, but they would love to be down the street in a different neighborhood, is only hearing price is high, rate is high, shouldn't get out of your situation of where you're at right now with your home. And it's, from this chart, that's certainly not the only side to things. And we need to be considering both sides of it. Income. Yeah.
Got it.
It's very interesting.
Good. Gabriela, what you got?
I love when we actually put everything together into, let's not just discuss the rates. I'm just going to reiterate everything that you're saying because it's true.
Yeah.
When you have to look at the socioeconomic, income of a household, that's gone up. A couple of years ago, we were looking at household incomes decreasing because of, COVID, unfortunately, people were losing their homes.
Right.
So now 2021, which is, last year when things started to pick back up again, people were going back into the workforce. Some job numbers reports have come up that, a jobs report is going better. It's better. People are getting more jobs. There's still a lot of jobs out there, but now we're looking at just from last year to this year, and it's positive to see that, but it's good that we're putting it together in one graph. So
I think it's something that we need to continue to get out there because we see it every day. And you're right, 2022 has really flipped the script on we're getting out of that. I lost my job in 2020. I got laid off. All of that. People are getting back out there, getting back into new jobs. And we're seeing this graph on the day-to-day when we go to refinance someone and we're updating their information from 2019.
Yep.
We're almost always hearing, oh, but yeah, I make more now. My income has actually gotten better, so here's the numbers, and it's always, for the most part, a positive increase.
Agreed. So Gabriela mentioned this maybe last update or update before. I listened to you, Gabriela.
Thank you. I listened to you too.
You're welcome, Gabriela. But when you're renting, if someone's in a renting situation, you're paying 100% interest rate. So whether your interest rates go from 3% to 4% to 5% to 10% to 15%, if you're renting, you're still paying 100% interest rate. So if your goal is to purchase a home, it doesn't really matter what the interest rate is, as the monthly payment is most important. Because if you're renting, you're always be paying, 100% to someone else anyways.
Someone else's interest.
It's so true. And to even I think a lot of potential buyers in mind, they're only thinking about, well, can I buy and save on my monthly payment at all? I'm paying this crazy rent of, let's say, $2,500. Well, if I can buy and lower that $2,200 a month or what have you, it's like, no, even if you matched it, you'd still be owning it.
Yes.
Yeah.
Yes.
It's not all about just saving on the payment. It's just getting that investment in there. And the way the market is going, it's going to pay off for you.
Agreed. 15 years is always better than 30-year. But on a 30-year mortgage, you're making $2,500 a month of payments. Probably in the beginning, it's closer to half and half of what's going towards principal and what's actually going towards the interest portion of it. But once again, even if you're only paying, $1,500 a month towards yourself, that's still better than paying $2,500 a month, 100% of that going towards someone else. One more point about this as well. If your income has gone up over, the past couple of years, where have your expenses gone? Like, did you add on a new Disney Plus, a new Hulu, a new this, new car? Like, what happens when did you start eating out more? What happens when your actual income goes up? Like, are you not seeing the actual monthly payment gains you should be seeing?
Right.
Because you're going on more vacations, things of that nature, because things have opened up since COVID has kind of come down, or at least in Florida.
That's a great point. How are you managing it?
Yeah.
Exactly. So those are good things to be able to know. What else we got, Gabriela, please?
You got it.
70% of medical debt to be wiped off of Equifax, Experian, and TransUnion. And we also just had a presentation as well that was talking about if medical debt is above $500 or less than $500, it's not going to show up on those actual reports anymore. And with many debts, if you pay them, they can come off of your report. But for medical, it's been a lot tougher to get them actually off of your report. And now they're saying if you pay those debts, they should be immediately taken off of your report now. Do you believe this is going to actually happen? And what do you feel are the implications of this?
Well, that's what we're being told, is that it will actually happen. And I think that it's great. I mean, to keep it minimum, under $500. I think I've seen so many people that I've pre-approved 6 months ago, and they just didn't find anything. We get them back into the home shopping realm, and we refresh their credit, and they had a $90 medical collection and lowered their credit scores like 25 points. And it's like, really, for a $90 thing that they didn't even know, they needed to pay.
Agreed.
So I think it's great, and it's going to help so many people keep their credit scores high if these little tiny, collections are not wiping them of what they've worked hard for in their credit.
Yeah, they're pretty annoying too.
Yes.
You get an alert, if you got Credit Karma or any of these other different things, you get an alert saying you have a new debt. You're like, oh,
right.
You go on there and it's like medical debt added.
Yeah.
You never had anyone contact you, nothing at all. It just went straight to medical, and now like you got to deal with the situation that you never even knew about.
Yes.
Gabriela, what you got about it?
Well, first, to answer the question, do you believe this will actually happen? I really, really hope so. I mean, the hope is there that it will happen. But like most things, once it actually happens and you're like, okay, great, now we can go back to the individuals that, were affected by this. But the most important thing that I feel about medical debt, also being a person that has experienced that, like probably a lot of people in this country, is that you can't predict medical emergencies. And there are people that are going broke and losing even homes and things, in life. They're not able to get things because their credit is now affected. And that could be the difference between, paying something that's important to them, whatever that important thing is. And my philosophy in life is that, medical is something that you just can't control, just like your time here on this world and what you do with it. And to have something like this ruin your credit score, we don't want to get into this whole, who gave that right to make that decision affect the rest of your ability to purchase and affect your credit like that. It would be the same as your circumstances that you're born in. You can't control those things. So yes, I hope it actually happens. What are the implications is there may be some regulation coming into the medical debt industry. You start from the hospital or the doctor, and something happens, you're clearly already going through a very traumatic event, whatever that event is. And then now they come after you for a few months if they notify you. Then they're like, after 90 days, we're done. We're just going to sell this off for a few pennies and move it on to the next medical debt collector. And then they're going to go for like 6 months to a year, whatever their terms are. And then they're going to sell it off to another one. And in your credit report, you have 3 different medical debt collectors for the same thing. So if there is regulation out there, I really want to learn more about it. But I do know that right now what you're saying is that 6 months later, when they're trying to go back into the home buying, process, and then their credit is affected by it, that is it affects our job is to be able to do that.
Yeah.
It's credit. You're buying a house, buying a car, anything that involves credit when you don't have cash. This, I really do hope it happens. That's probably the only somber note that I would add about the whole medical debt experience, personally that I've gone through, but I've also known other individuals, and I also see it, as well in some of the conversations like, wow, 25 credit points gone.
Yeah, there's a lot of goofiness when it comes to the whole medical collection industry. A couple more points on this. Credit in our business, in the mortgage business, is important. It's not always as important as buyers think it is, though. For example, anything above the 740, you're getting the same numbers across the board. So whether you have that 750, that 760, that 800, it's going to be the same across the board. I have plenty of buyers that are very obsessed with it. They're like, oh, my credit's 800, but let's not pull it because I just saw it went down to 750. I'm like, yo, pull it. Your numbers are going to be great. You're going to be the top tier when it comes to rate. You're good to go with that. Don't get crazy about it. But if you are playing the credit game, medical collections, they can hurt you, but most important is going to be those credit cards. That's always going to be the most important when it comes to the actual game. And we're constantly learning stuff all the time when it comes to this credit game. Unfortunately, I wish I had credit helpers who were great in the business. We've all gone through probably 10, 15 different credit people, and many times they're not.
Well, I think that it's just hard. I think it's really hard
to
try to go back and fix. So, these consultants that we've worked with, they have some techniques and some tips, but it's just really hard, and we have to continue to get the information out there of how to play the credit game. It's a game. It's a total game, and some of it does not make sense at all. But you have to play the game. Everyone has to if they want to finance anything. So.
You were correct.
So I'm going to add something regarding what you said about credit cards, and it kind of tied in a little bit to medical debt. When you have individuals who are using their credit cards to pay off medical debt, and the medical debt's wiped out, right? They paid for it, but now they can't pay their credit card. So, but that goes back to individuals' decisions to how am I going to pay off this? I don't want this to hurt my credit, so I'm just going to use my credit card to go ahead and pay for this. And there's definitely some lack of financial education in that sense. And, yes, we want to teach the young how to do it as soon as possible and not get to our age where they're learning it now. But I do feel that there are some medical situations where they want you to take a credit line out to pay the debt. And so it kind of is like, well, yeah, you can pay it, but we're going to run you through this credit line program to help you. So I don't want to go down the rabbit hole of that, but I certainly think that is something to consider for the consumers when they're out there and they're discussing their medical debt and, when and hopefully this happens.
Sure. Medical payoff is the last step. And we just were on a call a couple weeks ago with the guy who was head of one of these credit, companies. And he spoke and said, because a lot of time in our past, we were told, don't even touch medical. Don't even touch it because it's going to be a bad thing. And he said in the last call, no, it can be a good thing, but you have to have all of them paid off, and you have to have all of them taken off the report in order for it to actually be able to help assist you. So like Brittney said, it's a game. Don't play the game on your own. If you're trying to buy a home, come to us. We'll let you know if your credit is already good enough to get the program that you want. If it's not, we can give you some advice on how to get a little bit better. And if it's really bad, we'll probably have someone to be able to help assist you to get you to that point where you can be able to afford a home. Good. What else we got, please?
Yes.
Home price appreciation in the last 80 years. Once again, the buyers that I speak to, and it's really 100% of every single last buyer I've spoken to over the past 4, 5, 6 months, they're all saying, oh, well, when it comes down, that's when I'll actually, that's when I'll actually, get real serious about this.
And this is look at this chart.
The last 80 years. I mean, we're going back to World War II, and all you see is a positive line besides 2007, 2008. And that's because people had no equity in their properties, with interest-only loans, refinance, taking all the cash out of their property. I mean,
having people buy homes for them.
Exactly.
Yeah, all kinds of stuff. And that is not going to happen again. So that dip, is not likely.
Yeah. What you got, Gabriela?
I just love graphs. I'm a visual individual. And when you talk about history, I love the history part of all this, right?
Thank you.
Yes.
Thank you. They got some shows out there nowadays too.
Yes.
A lot of Netflix shows are in the history department.
Yes, I just watched Operation Mincemeat, Squirrel Woman here for you guys, because that does happen. But it was just in World War II.
There you go.
But I will talk about that another time. But the historical aspect is like when people, there's a good old saying, if you don't learn from history, you're doomed to repeat it. So,
Preach, Gabriela.
Hold on a second. There's a history teacher in 8th grade that would be very proud of me right now. But this just lays it all out. This is actually the history of the U.S. economy. And this is also the history of, where you mentioned World War II, because that was such a significant time period in the U.S. because coming out of the Depression, going into another war at this point. And then as, if these families are coming back home, the government institutes this program about building communities, affordable communities for military personnel to come back to. So, you start seeing, kind of where this graph is, and then people are starting to travel more. Then you have the Eisenhower Project, the interstate project. So people are traveling more throughout the country as well. If we could just overlay that historical aspect of it, you will see why the numbers are looking the way that
you're
they
right.
are.
People were holding on to homes for so long and living in homes for actually 30 years.
One income households at that point too. And there's so much that this graph shows when you really want to sit down and actually talk to somebody that actually can pinpoint certain key points of history. But history also is there. Yeah, where are we right now? 2021, there's a little bit of that COVID episode that we're all going through still. There's still some lingering of it. The 2006, it's highlighted in here because that was also another significant point in the home buying economy. And so I love it.
Good.
As much as I want to say about it, I just love it. This is a good historical aspect.
Yeah, so us in the mortgage world, we preach this. We may not all have seen this exact graphic, but we're all preaching that like home prices are going to stay high. Yeah. But unfortunately, the news does not operate that way. The news operates for you to get, obsessed into whatever they're telling you.
The wow factor,
Exactly. So unfortunately, if you go to the news to get your doctor's advice, they're going to be telling you something to get a wow factor for what's happening medically. Yeah. If you want medical advice, you go to your doctor. If you want mortgage advice or you want car advice, have someone in the car industry tell you what's happening in the car industry. Yeah. If you want mortgage advice, come to a lender to be able to get mortgage advice, because we're in this every day and we have the actual specific numbers and data for it, rather than the news, which is just there to be able to, drop emotions in you.
And that's why it's important to see these graphs, though, for consumers, is that way when they come to us and we say, don't wait. It's not a sales tactic. Yeah. We're saying don't wait. You need to buy now.
Yes.
It's not something to just get you under contract on something. It's not for our sales techniques. It's right here. It's showing you that you should not wait.
You got it. Good stuff.
Yeah.
What else we got, Professor Gabriela?
Next time I'm going to swear my monocle and put that in there.
Do it. I'll get a pipe. FHA thinking about loan modifications for people that are delinquent to be able to go to 40-year mortgage. So they're already in a 30-year mortgage, situation's not going good. This is not law yet, but they're thinking about this supposedly, to be able to modify their loan to be able to go towards a 40-year mortgage. Think about this, Brittney.
It's interesting. It could certainly help in a time of crisis, but it can also, if we've got a lot of people out there changing to a 40-year mortgage, it could also be pretty detrimental to the industry.
Sure.
Having a bunch of 40-year mortgages out there that, would obviously take 40 years to get paid off.
Long time.
That's a long time.
Yeah. What do you got?
So gonna look at it from one perspective first, is that, and I'm gonna go back to, I love car buying stories, because I always think that if you relate it to something that you know, it's a smaller dollar value, then you can kind of explain it in a higher dollar value. There was a time when you could buy a car financed, and, you know, you could do 3 years, 3 years, pay it off a little bit higher. You could do 5 years, 60 months, I saw 72 months to pay off the car, 6 years. Please help me with my math. I'm not the math number.
6.
6 years, and we just paid off a 6-year loan car.
Congrats.
Thank you. But what was interesting was that I've never heard of those financing terms, and coming from a family that worked in the car industry for a while, not salespeople, but just in the industry in general, and it made it affordable to buy that vehicle, but you had to look at it in the 6-year term.
Mm-hmm.
Now we're looking at it, and I, there was a point where I was like, maybe we should refinance. The interest rate's a little high, but we only got 2 years left. Really, if we were in a 5-year, we probably only had 1 year left, and we could have made a different decision at that point. But we still did the 6-year. Now you're looking at a home mortgage for 40 years. So the FHA, and I don't presume to know anything about their thought process, only that they're trying to look out for the consumer and set those guidelines, is that, a 30, we're talking about 15, if you want to pay it off quickly, it is a little bit higher, but you can pay it off quickly. Then you're looking at the traditional 30-year, which most people are very comfortable, familiar with, but has that 30-year just become unrealistic for people, that they're now looking to do a 40-year, so it makes it more realistic for the buyer because of the property value or the loan amount, because the average loan amount in the country right now is between $350 to $400 range, depending. It's like the average, and then we have to look at different states because they have a different one. So, but in 40 years, a lot of things happen. 40 years can be, there's a lot of life changes. The home can be resold. So that's really, we don't know what that looks like later on.
Yeah, I mean, when we know on average how long people stay in homes, right?
But that could change, because back in the 1940s, people did stay in their homes a little bit longer. Mm-hmm. So I don't know what the social impact will be for a 40-year mortgage on people. I'm looking at it from is it to make it more affordable for people right now? And then later on, maybe they can sell it and refinance or whatever needs to happen at that point, whatever life decision. But if that is the case, to make it affordable, then maybe I'm making a good educated assumption or guess as to what that is. Because this seems like it's very new, and you guys have been in the mortgage industry a lot longer. You guys have studied mortgage history more than myself. So is that a different point of view?
Yeah, I mean, I think, you make great points, and it goes back to, again, in a time of crisis, or you get laid off, one person in the household gets laid off or something like that, where you need to lower the payment to a 40-year, it can save people in their homes, certainly.
Yeah.
But the repercussions are you're not setting yourself up for as much financial success. A 15-year mortgage we talk about terms, and a lot of people only think of how long it takes to pay it off, and shortening the term is, we'll just have it paid off sooner. But people do not think about how much interest they're saving with a shorter term as well.
Correct.
So financial success, 40 years not going to get you there, a 40-year mortgage.
Correct.
But it can certainly save someone in a certain situation.
Yeah.
But 15, 20-year terms are much less in interest. You're setting yourself up for much more financial success in the future. Whereas a 40-year term, certainly would be way less.
Understood. I'll piggyback off of what you're saying right now. And this goes back to that one Gabriela quote, which is, if you're renting, you're paying 100% in interest.
Mm-hmm.
So going from a 30-year to a 40-year, you're increasing the percentage of how much you're paying is going to be in interest.
Mm-hmm.
So I don't have the exact numbers, but let's say 40-year, let's say 30-year means you're paying 50% interest, 50% towards principal. 40-year could be 75% towards interest and only 25% towards principal.
Right.
The more you go towards those longer deals, the more you're technically not owning. You're still, from a financial standpoint, you're still kind of technically renting.
Yeah.
And yes, we just saw in the last graph, mortgage prices have been going up over time, so you still have that to lean on a little bit.
Right.
But from a financial standpoint, you don't want that to be the main thing you're leaning on.
Yeah.
That's kind of like the dessert part of it. You want to lean on the, I'm paying this off as quickly as possible so I can be able to own this and have this big asset in my name.
Yeah.
So
and not only interest over the whole term, but interest is so heavy on the front end that we know on average people are staying in their homes about 10 years. I think it's recently changed to a little bit longer, by a year or so. But if you're so heavy on a 40-year mortgage on interest on the front end of those first 5-7 years, and you only own the home for 10 years, you barely have an asset there.
Yeah, I'll say if it saves you, because here's the thing. What happens is during hard times, many people don't speak with their mortgage people. They either stop making their payments or do something else goofy.
You're right.
And that puts you in a really bad situation if you don't communicate with us what's happening with you. There's many different modifications. This is not a program that is yet, but they're discussing it. But there's plenty of other programs to help buyers who are in bad times.
You're right.
But if you go on one of these modifications, 40-year, any of the other ones, you're now in that period to where over the next couple of years, in my opinion, you got to determine, am I going to be able to go back to a loan that's not a modified loan? Is this the best situation for myself and my family, just doing only this interest? Because if it means you're being able to sell that property and you get a ton of cash out of it, but now you can be able to live with a family member for a year or so to be able to get back on your feet. If someone's in a hard times for a couple of years, that could be more beneficial than you being in some mortgage that's on a modified plan that is not going to be benefiting you and your family because you're not able to actually pay down that mortgage really.
Yeah.
So
and realistically, going from 30 to 40 probably is going to affect your payment by a couple $100s.
Exactly.
And so again, we go back to how are we managing our money? Is there Netflix that we can cut out and eating out and those sort of things before you consider something like this?
Agreed. Good stuff. What else we got? And we're on our last few slides, by the way. We're making it.
Right.
Got about 4 left, maybe 3. Home appreciation has outpaced inflation. So getting back to that appreciation number, people think about homes going up, and homes going up in value is a good thing only if it's beating inflation numbers, because inflation means the cost of everything is going up. So if home prices are going up more than that, that means that you're still able to get a ton of equity in your property. So if you see everybody see this on YouTube, but from what we're looking at right now, 70s inflation, got up to around 7%, but you were able to have home appreciation around 9%. 80s, it was about the same, 5%. 90s, inflation 3%, 4%, all the way up until where we're at right now, where inflation is pretty high, 6, 7, 8%. It's 8% now. They project it to potentially go to 9, 10% over the next couple of months. But home appreciation is around 18% as of last year. Overall, what are you getting from this, Brittney?
It's a great time to refinance for someone that may need that appreciation for other things. Use the equity out of your home if you own currently to pay off some debts that might be a really high monthly payment and get rid of it. It's a good spot to be in. I mean, it's if you're a homeowner currently, to know that your appreciation has gone up that much. It's a good feeling to know that you've got a good amount of equity for sure.
Good. Well, the great thing, just real quickly thinking back about a refinance, is that you still keep 20% of your equity in your property.
Right. Yeah, we're not putting you at matching your home equity. Yeah.
Exactly. If your home was worth $350,000, we're not, and you have 100% equity in the property. We're not saying, hey, you can get $350,000 out from this property.
Yeah, we're not taking you every penny.
Exactly. We're only giving you up to 80% of the amount of equity that you have in the home. So you're correct. That can still be able to help you out. even though I wouldn't recommend pulling out to buy a new boat right now. But if you're planning to, in my opinion, number one, be able to make improvements on debt, being able to pay certain debts off. Many people are doing it for home improvements. Do understand though that whatever you put in for home improvement does not increase the value. If you spend $15K on home improvements, that does not mean your home is going to go up $15K in value.
Right.
99% of the time, it'll go up a little bit in value, but it's not going to be astronomical unless you're adding on rooms, things of that nature. Gabriela, what you got for this?
Honestly, I'm just gonna be, looking at it like, so 1970s, 2021, and in the 2000s, oh man, that was a tough decade for everybody, but that's also where the market crashed and a lot of things that happened.
A couple crashes.
There was also, the war that happened, after 2000, 9/11. Sorry, I'm just going to reference that point. So, what was happening in our country at the time, and as well as with individuals, they started feeling more comfortable in home ownership and the economy of the 2010s than in 2020. So, overall, from a bigger economic standpoint, it's better. It is better now for the home values. One of the things I think we are starting to notice that we're doing less refinance deals, but I think that's also because people don't realize what they could benefit from it. When you guys refinance, and I say you guys because you guys are the loan originator experts,
Thank you, Gabriela.
You're very welcome because, I stay in my lane when it comes to stuff like that. Good for that. Is that, when you do a refinance, and this is where I want you definitely to make sure that I'm saying this correctly, what you use that money for is at the same interest rate of your home.
Yes.
So if you're paying off a credit card that is at 29.9% or 27.9, I know that there's a max. If you have student loans, I don't, whatever the reason that you're using the money for, is it going to be at the interest rate that your home is, which is in the 5s, wherever their interest.
No, you're totally on track.
As opposed to the debt that they're going to pay off, which is at a higher interest rate. Mm-hmm. For your family, you're coming out in the long run.
Yes.
We're going back to building wealth through real estate and how to actually use that wealth, because we talk about you can build wealth, financial wealth, legacy wealth, through real estate. But what does that actually look like?
Yeah.
And there's not a lot of people need the education on it.
Yeah.
If they don't know how to actually use that real estate.
Right.
Yeah,
that's a great point to touch on, the interest rates of the other items, the other trade lines that you've got. If you're higher than mid to high 5s, then it's putting you in a better situation to refinance.
Yeah.
And lowering terms and things like that. Again, we can go back to, are we making more money now? Well, then maybe you can afford to lower your term and get out of that mortgage sooner and lower the amount of interest over 15, 20 years that you're paying. And again, going into a better financial situation.
Yeah.
What does it actually look like? And that's why it's so important that you use a lender that takes time to talk about these things.
Yes. And
we've always said, until the recent years, back in these times where the inflation and the equity wasn't so high with people, we would talk consumers out of refinancing. This isn't the best thing for you financially. But in the recent years, it has made so much sense to, and we've been saving people hundreds of dollars a month in refis.
Yeah. The piggyback, you guys have both made great points, so I appreciate that. One extra thing, which I'm always committed from a mental health standpoint, is if you're able to refinance and pay off other things, making one payment towards a mortgage a month versus having to send out 10 different checks a month, it feels a lot better.
Yeah.
A lot better to have just that one that you're thinking about rather than all of the 10. Like I said, I come from the reverse Dave Ramsey method. He wants you to pay off all these smaller debts, and then once you have everything paid off, get into a home at the 15-year. I say get into the home any means necessary. Use that home to pay off the smaller debts, and then you can finally, hopefully over time, refinance to be able to get to a point to where you can have a 15-year mortgage.
Yeah.
All right, we may have to speed this up because my battery's getting low on my computer. And I forgot
Well,
to.
unfortunately, we don't have much left, so let's go.
We don't. Let's get it.
Let's do it.
Let's
All
get
right,
it.
go ahead, Gabriela.
All right. Oh, it's me.
Out of the box home lenders. One company gives you cash for the price of your current home, so you can buy the next home with cash. Another company is, helps you purchase a home by securing your offer, cash offer. They take fees, of course, but if it makes your offer considered cash, there's a lot of these new companies that are coming out that are doing these types of things. Where's your head at with that, Brittney?
Quickly, I'm going to say my thoughts on it is this is a tool in your toolbox, just like first-time home buyer down payment assistance programs are. They make sense for certain situations. So they're great. This is a great option to have. We can also work through certain aspects of these situations where if someone can just afford to put 5% down on their next home, if they have enough money in their accounts to put 5% down and get into that home and then sell their home, and they can make a principal reduction. We can get into all of that. But we have options that we're exploring, and then this is an option if those options don't work.
Agreed.
So it's great in certain situations.
Got it. What you got on this? Anything?
Only that I love the fact that we do this. We are traditional lenders, but we're out of the box thinkers too.
Yeah.
And the companies that we're working with.
I'm actually going to try to put two. I know we only got a couple more minutes left, but
Yeah.
that'd be the worst is I just cut off right in the middle of
He's
it.
like, the combo is really good.
Very good conversation.
It's us
It's
now.
us now.
Hey.
All right.
So when our company vets these portfolio products. and
Yes.
stuff,
Yeah. We don't just throw them in there. So.
Yeah, and that's actually, to expand so that we can present as many options as possible.
Exactly.
And instead of people just thinking like, oh, I don't qualify for FHA, and all of the out of box thinking is that it takes a unique buyer and buyers to actually say, hey, my situation is like this. Can you guide me to a program that will work?
Right.
And we exhaust those opportunities. We
Yes.
exhaust every possible aspect of like, how can we find an out of box lender
Right.
that we are comfortable working with, that you're going to be in good hands.
Right. Yeah. And that's the reason why we collect all of these different out of the box things is that we go over the options that we have first. And then instead of exhausting those options and having to say no, which we don't want to say to anyone if we don't have to, now we have extra leaps and bounds that we can take for people to get them into the right financial situation, not just throw them into a box, but thinking out of the box about their long-term gains and financial status of where they're going to be. Because at the end of the day, what we always say is, we're not buying this home, you are. And you have to make the payment and you have to be happy with the situation that you're getting into. And so we want to make sure that that's not just easy for us. Here you go. Here's a vanilla thing for you. What's going to make the most sense for the buyer?
Let's add some sprinkles.
Yeah.
So,
Sprinkles, you can have all the sprinkles. Not for me.
let's add some sprinkles to it. And also kind of maybe adding to that is that, it makes us competitive.
Yeah.
It makes us competitive against traditional bigger, bank lenders. If you're using one, this to sign that.
It sets us apart.
It does. If that program worked well for you with that, with your bank, that's great. The end goal is to have more people buying homes.
Yes.
We're just trying to give you a competitive edge with as many options as possible, but exhausting first our traditional options first.
Right.
And then when a client actually feels like you're taking that extra step to go above and beyond and see where I can, who I can work with, that sets us apart. And
well, it changes people's lives.
Yeah.
There's so many times that we take over buyers that have started with another bank and they'll say, I don't know, they just told me this is what I needed to do.
Yeah.
And they didn't explain anything.
Yeah. Or they didn't know what questions to ask.
Yeah.
And so, this is a good education media. We talk about all different things. We're not just here to sales plug, certain programs and stuff. we want to discuss all of the options. So
Yep.
I know you were grabbing the charger, and we kind of took over. You know,
Right.
just
Y'all said, John,
So
we're
go
gonna knock
ahead.
him out.
go get him. Go get a charger.
So what are your
What
thoughts?
are your final words on this section?
Thank you, ladies, for asking for my thoughts. I appreciate that.
Oh yeah,
Well, I'm kind of distracted right now. I'm thinking about sprinkles. I'm like, do adults like sprinkles?
I do.
You like sprinkles?
I do.
You like sprinkles?
I mean, sometimes.
Yeah.
I thought this.
I don't
was gonna
know.
answer differently.
I
Like
mean,
cupcakes
on
and
a
stuff?
donut,
Donuts.
That's
Yeah.
true, donuts.
you know, like a strawberry
Homer
frosted-
Simpson
yeah,
donut.
like
I
a
forgot
Homer
donuts had
Simpson
sprinkles on
donut. Yeah, Homer Simpson.
The
Never
pink
mind.
strawberry.
Never mind.
Maybe not on like a sugar cookie.
No, those are messy.
Right.
The donut just
Those are
holds it,
messy.
it holds it together.
Wow, I will keep my opinion to myself.
But is this what happens as you get older though? Like I feel like every kid likes it, and then when you get older, you just like, no more sprinkles.
And
That's
then
what I was thinking, that you grow out of it, but then
No.
you said donuts, and then I'm thinking about like cupcakes still have them, and
Right.
I'm like, I guess you guys still.
Funfetti, baking
Mhm.
mix. You know, none of this has anything to do with with lending, but man, I really
Now we're all getting donuts afterwards. But yeah,
Oh, yeah.
there's a million different options. Buyers and real estate agents. If you go online, you will spend hours and hours looking up all these different programs.
Oh, yeah.
Work with a lender that has access to many programs that can be able to quickly give you the answers on these programs. Because if you do it on your own, it'll end up
Oh my
taking you
gosh.
a lot of hours.
Well,
of
yeah, it'll be super
rabbit
stressful.
holes. Super stressful, rabbit holes, etc. 2 more slides. What we got?
Yeah. Oh, and
Please.
only other thing, and hopefully this is kind of relevant too, is that when people do, try to look for these out-of-box lenders and stuff, some of them don't work directly with the consumer. They work through, a direct lender or another vendor
Mhm.
partner.
Yeah.
At that point. So, going back to your point, start with us. Let us go through all your options and break it down for you and see which one works for you.
Sure. What else we got? Please.
What else you got? You put the slides together.
I apologize. I should have probably put this slide a little bit earlier. This slide's got a lot of information on it, but hopefully
Wow.
we can get through it quick.
Wow.
Lots of charts, lots of graphs.
Holy moly.
Might just skip
Into
over this
this one?
That's what I'm saying. Maybe. I got a little goofy just now. But there's a lot going on. Forbearance, foreclosures. Many real estate agents are just always talking about, or is there going to be a ton of homes coming on the market because, people going foreclosures, et cetera, et cetera. So forbearance means that, they're able to not have to make their payments. You see a lot with student loans. It also happened with the housing industry. They made it very easy for people to be able to go on forbearance a couple of years ago. So that was probably about 5 million households that were at that point when it first happened a couple of years ago. And now we're at almost less than 1 million that are not in forbearance plans anymore. And the people that are outside of forbearance, a majority of them are in what we'll say is the green, which means, they've either paid it back up, they paid off their mortgage completely, they did something to where like they've overcome the payments that they've missed.
Yeah.
Another piece of the pie, probably 30% of it, is people that have modified their loan of some sort. And then about 17% are, they're kind of in the red area to where they're trying to figure out what they want to do with the situation. And the last number that we have on here is that 413,000 fewer foreclosures in the last couple of years. So it's pretty much less than 1% of the market. If you look at in the Tampa Bay area, there could be 2,000 plus homes on the market in a given month, and maybe like 3 are short sales, foreclosures, things of that nature. Looking at all this data, I know it's a lot to be able to look at. I know it's the last couple slides, so you can get it long, short, however you want to do it. But what's your vibe on this, Brittney?
My thoughts are that yes, thank goodness the forbearance was there for those who needed it during the pandemic and the heart of it when a lot of people were not able to work and not getting an income coming in. But we're making our way out of it. Let's get out of it. Let's, get back to work and get those payments made. Fortunately for a lot of people, the home appreciation helped them. They still have that equity in the home, even though they may have gotten slid a little bit back with the payments, but you still have such a healthy amount of equity. At least we weren't in a market where it was real tight,
Yes.
So that was working for them. And yeah, I mean, we're getting back to it, and we're getting back to a very healthy standpoint.
Good. Gabriela.
Honestly, everything that you said is absolutely correct and true. And we're going to go back and talk about, I'm just going to mention, for the individuals, whether they're the buyers or realtors, who still think that there's some market crash that's supposed to happen.
Right.
For real estate, at least. People are projecting for other ones, but
yes,
for the real estate
our
side.
focus is going to be on mortgage and the real estate, but the mortgage side of things is that, the data is kind of showing right now that that's not where we're headed. We're not going to look at 2009, 10, where all these homes were available, investors were picking them up left and right, because one, the inventory is just not, the inventory is not there like it was back then. Two, all of these programs that were put in place, those were put in to stop that from happening. So there were some lessons learned from back then as well. And also COVID, another medical, situation that was out of everybody's control, happened. And so, things were put in place to help people still keep their homes and not lose them. To look at the 18.4% that are still in trouble, there's got to be a lot of different reasons why that's happening. We don't have the data or specifically target, but there were people who lost incomes that they are not going back into the workforce either. I did mention that in the last podcast, is that there are people who are just not going back into the workforce. So if they're not going back to the workforce and their homes are now in jeopardy, I hope that people don't just give up on their life and just say, forget it, the home and everything. But we're also seeing a trend with multi-generational households too. Something that, from a Spanish culture, I have a multi-generational household. So as all these things were happening, they didn't impact us because we were already, together. Yeah. And so when we're looking at foreclosures now in the last 2 years and seeing that there's 413,000, that's like a small county in Florida of homes. So Britain, these are numbers for like the whole country, right?
Correct.
Okay, just wanted to make sure I'm putting it back into context. It's just small, and so when people are still getting hung up and thinking about that, I still think that they're going back to what they're hearing in the news. They're like, oh my God, this is going to happen, but they need to have these conversations with individuals who they actually trust, who are experts, and can guide them if they're looking for guidance. But if you're just looking to be, the Chicken Little and like the sky is falling and this is what's happening, there's data to say it's not, at least from what we're seeing right now.
Yeah. Communicate with the experts.
Yes.
If you're in a sticky situation, there's ways to be able to mitigate that. Don't just stop making payments.
Yeah.
Communicate with us. Last slide, please.
The finale.
We got through that giant pie chart, everything slides.
Yeah. Yeah, a lot of information, but it was all relevant to the topic.
Yeah. Interest rates continue to go up, and in our company, we have the option now to lock loans, because you don't lock your loans only until you're under contract, and it's only either 30 or 45 days. And the most companies that have will be around 90 to 100 days. We now have the opportunity to be able to lock them for 330 days. Any feelings on that, Brittney?
Again, certain situations, it could pay off. It's hard to know the exact right answer because we don't know what rates will be in 330 days. So our job is to explore the different options for our buyers, give them the different options, and then let them choose. What I have learned in the past 10 years of doing this is that my perception of money is going to be different than someone else's, and I cannot put that onto someone else. If I would do a 330-day lock, I'm not sure if I would. But someone else can look at the numbers, a buyer, and say, yes, I definitely want to do this. It makes me feel secure that we can lock it in at this rate, no matter what rates do. Maybe the end of this year will be into the sixes, high sixes. I mean, we don't know. So if that makes someone feel secure and they want to do it and they have the numbers in front of them, we are very thorough with what we give people. We don't just breeze over these things with them and the costs and what the payment is going to look like. We go in depth. And so if they're fully, educated on it and they want to do it, then let's do it. It certainly, you'll know what your rate is.
There you go.
You won't have to worry about that.
Yeah, you're correct. Gabriela, what you got?
This is new, right?
Yeah.
I just want to make sure that we're putting it into context that this is a new, program that is being rolled out, to lock for 330 days your interest rates. So there's going to be the two types of buyers. The buyers who think that eventually the rates are going to go down, so they're not going to, no matter what you tell them, pros and cons, data, this is where things are going. Their mindset is set that, nope, I'm just going to wait it out because it's going to happen.
Yeah.
Same as the buyers who said, no, I'm going to wait till the prices go down and I'm going to buy them. Then you have the buyers who have been keeping up with what they're seeing, the savvy buyers, the people that took the time to get educated or have gone through this experience already before. And they may see this as like, you know what, it's a peace of mind. But with the peace of mind comes also the commitment and the obligation to also make sure that for the next 330 days, and hopefully it does not take you that long to buy your home, but that you have this buffer of time. And I kind of see it like a TBD kind of situation where you still have to make sure that you're providing us the updated documents so that everything stays current, so things aren't changing in your loan, so that this blocking of the rate makes sense also. And then, this is just one option right now for a peace of mind. Same as what happened with the forbearance. You look at all these things that people that, whether it's lenders, government, and everybody are putting in place, it's to kind of bring back a little bit of peace of mind to the consumer. Because consumers right now, and there is some actual charts, about consumer confidence right now, and where it's at compared to where it was before, and it's not really good right now. And that's because there's a lot of fear in the unknown, and there's also people that went through the market crash. So they're very much like, oh no, I'm afraid and I already know what's going to happen, even though they did see some things happen, but their mindset was, no, I got to prepare for the worst. And then you have the baby boomer generation, that, is still with us, that has seen all of this stuff, So when I put all of this together, it's like, I think it's a great idea, but at the end of the day, your job is to present the pros and cons to the consumer, and it's going to go back to what the consumer feels is in their best interest, and also if they're committed and serious to the buying process.
Yeah. I mean, I think that a really long amount of days, maybe 200-day lock for someone that's maybe building, is a great opportunity. I think for someone out there looking right now, that it may take them 60 to 90 days, a 90-day, even maybe a 120-day lock to make them feel secure while they're out actively looking, can be a great option too. So you could stack a locked-in rate and a TBD loan where we're underwriting you ahead of time and feel very secure.
Yep, you agree. This also comes with the option of a float down, at least with our company, potentially.
Yes.
So the interest rate when you're going to closing is much lower. It can potentially be negotiated where it can come down a little bit for the buyers. But yes, peace of mind, that helps out a ton, but it's going to always come down to what the buyer wants. When it comes to the situation, we're not going to tell you what to do, we'll only advise you. But overall, ladies, this is it.
Yeah.
That was the last slide.
It was great.
It was good.
Yeah.
It was good.
What's the sprinkles?
Yeah, so I appreciate, Gabriela, as of course, always having you on there. Brittney, thank you for joining us this week.
Yeah, thanks for having me.
Thank you.
Of course, having to have a babysitter.
Maybe I brought a little sprinkle into it.
Yeah, you did.
Sprinkles.
We're gonna all leave here just thinking about sprinkles. That's gonna be the thing we all leave with. But thank you all who are gonna be watching this, listening to this, and I hope you have a great rest of your day.
Thank you guys.
See ya.